Page Industries, manufacturer and retailer of innerwear, loungewear and socks, beat street expectations in Q3 FY21 with the company reporting highest ever revenues and profitability. The company, which holds the license for Jockey International in India, Sri Lanka, Nepal, Bangladesh, UAE, Oman and Qatar, returned to a strong double-digit growth trajectory after a gap of 4 to 5 quarters. The stock has gone up by 10% since our recommendation on December 22, 2020 and has performed largely in line with the benchmark Nifty, which has given a return of about 13%. At the current market price, the stock is trading at 60 times its FY23 earnings. Let's talk about the performance and key drivers of growth. Revenue grew strongly by 17% on year-on-year basis, driven primarily by volumes, which grew 10%. Net profit increased by 76.6%, while EBITDA saw 62.9% uptick. Operating leverage, improving efficiencies and cut in discretionary spending led to EBITDA margins improving strongly by 690 basis points. Gross margins improved by 220 basis points on year-on-year basis, driven by better mix and price hikes. With further opening up of the distribution network, at end of Q3, all the exclusive business outlets, 95% of multi-brand outlets and 93% of large format stores were operational and continued store addition with revenue trajectory which was strong. The company has been receiving good response from the kids wear segment, with business having crossed rupees 150 crore revenues, that is 6% of overall revenues. It has 28 exclusive business units for the segment and plans to open another 20. It currently has 192 Jockey Junior channel partners and expects kids wear to be a key growth driver. Page has enhanced the pace of network addition and would add about 10,000 multi-brand outlets in FY21, as against an average of about 7,000 historically. Company is also strengthening its exclusive business outlet network. The company is working on reducing waste and improving efficiencies. While the yarn prices are increasing, the company has taken price hike in August 2020 and would undertake a pricing action again in March 2021, which would largely sustain the margins seen in Q3. Let's come to the company outlook. Management expects to maintain the 21 to 22% EBITDA margin, which is the long-term historical average margins. Rural areas, tier 3 and 4 towns would be the key focus markets, as management believes that they have huge potential. Page has done pilots, especially in the northern and southern markets, for about 6 months and has received strong response. Page is a debt-free company with return ratios in the range of 30 to 50% with high dividend payout of about 50%. With enough growth levers, the earnings visibility is strong and the stock would continue to provide healthy returns. We advise investors to add the stock in their portfolio.